The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes. And since it's the beginning of tax season, we figure probably you're getting all your stuff in. You might have some questions. We sure want to help you. I'm Esther Gulius, the Tax Lady, and Christopher Fabian. I drug him out of the office.
Hello, Esther.
Hey, Chris. How you doing?
I'm doing good.
Anything we should share with people? Interesting things happening?
Just make sure you have everything. Double check your figures. Open your W-2s.
Yeah, that would be nice.
I mean, I had a young lady today come in. Oh, here's my W-2, and it was the health insurance form because she didn't open it.
Right.
So
the other thing is if people are using box software, you want to make sure that you have the latest version of it because 5 days before the end of the end of the year, they made all these tax law changes under the Secure Act, and you want to make sure that the changes that went into effect is in your software that you're using. For instance, the tuition and fees deduction, the medical expense deduction, the PMI, those kind of things. You want to make sure that you can deduct that. And if your software doesn't give you the opportunity to, because they didn't know that they were going to change the law.
Right. And just because today's February 1st, 95% of the stuff should have been out by yesterday. It means postmarked by yesterday.
Right.
Doesn't mean in your hand. There's still your financial information, your dividends, your brokerage statements. They have to February 15th, and then they usually file an extension.
And then how about New York State unemployment? Where do you get that from?
You have to go online and get that
yourself.
yourself.
Get it. Yep. They're not going to mail it to you. And just because don't be lulled into a false sense of security where you say, well, I didn't get it, so I don't have to put it on the tax return. That's not true. If you got the income, then you have to make the effort to get it, and your unemployment is not going to get mailed to you unless you call and ask for it. Right. So if you don't have a computer, you can ask for it, and they'll mail it to your house. So I'm Esther Gulius, the Tax Lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 3930. We got all of our offices open from as far south as Fredonia out to almost to Rochester, all over Western New York, Arizona, and Florida. And if you have any questions, we'd love to help you. And by the way, if we're off the air and you have a question and you're at a dinner party and people are saying, I think that's tax. No, I don't. Just go to egtax.com, ask the tax lady, put in the question, and I'll get back to you.
Yeah, so put a bet who has to eat a tablespoon of hot sauce if they're wrong.
Oh, but that would kill you, wouldn't it? I think that would kill you. So today, we thought we'd talk about income because not all income is taxable. And a lot of people, especially if you're a do-it-yourselfer, you don't know if it's taxable. Like, for instance, there's a line on there that says New York State refund, or it says state refunds from last year. For most people, in New York State, you're not going to use it.
Right.
Because there was no benefit to itemizing using your state withholding last year because of that cap, unless you don't have if you don't have property taxes, maybe if you itemized, but you had to have gotten a benefit for New York State withholding in order to have your New York State refund be taxable. And a lot of people, because it's on the line. On the tax return, they think it's taxable.
Right.
Right?
Yep, because that's what it says.
That's right. So bartering income. People don't know that if I'm an electrician and you're a plumber and I say to you, Jack, I'm going to come and wire your house if you come and fix my toilet, that income is taxable to both of them.
Right.
Because they bartered.
Yep.
Right? Or I sure would come fix your house if you give me your boat. Right?
Yep.
I mean, that's people don't realize that bartering income is taxable.
Yes, most definitely.
And debt cancellation, many of you are going to be getting 1099-C forms, and that may or may not be taxable.
Right. And that's people, well, what do you mean? Well, you got to look to see if you're insolvent. And it doesn't look at your income. It looks at your assets versus your liabilities. You know, what is your house worth? What is your bank account worth? What is your IRA worth? What are, you know, and then it says, well, how much are you in debt? How much is your mortgage? How much is your home equity? How much is your credit cards? How much is your student loans? And if your liabilities exceed your assets, then
At the time of the debt cancellation.
time of the debt, then that money is tax-free.
Free, right. And you have to fill out a form and ask for it to not to be taxable. So, and then that form accompanies the tax return. So just because you get a 1099-C form, don't just put the income on the return until you do that computation. And most people, I find out, why would you have had a debt cancellation if you could have paid the liability?
Right. Yeah, most, I usually ask, could you have filed a bankruptcy? Could have you done a Chapter 13? Or did you go to some of these credit counseling places? And, well, because they'll already have done that paperwork for you.
Right.
So that will tell you if they're insolvent or not, where they don't have to do all this again. So.
Okay, and then obviously another thing that's taxable is your W-2 income, which will include severance pays, tips. So if you're a waiter or a waitress server, those tips are taxable. Reimbursements on a non-accountable plan, and this is so important. There are so many people that they're working for small employers, and the small employer doesn't understand what a non-accountable plan and what an accountable plan is. So if you're somebody that's just getting paid by your employer on a reimbursement and you don't have to submit the proof, and he doesn't or she doesn't reimburse you dollar for dollar based upon the proof, they're just giving you a flat amount, they have to include that in your wages. And is it deductible to you? No.
Not anymore.
Right. So it's really important. If you're getting reimbursed, that reimbursement's on your W-2 and you can't take the expenses. It's much better to sit down with your employer and say to him, can I just submit the bills so that you can give me back exactly what you reimburse me? Because then it's a reimbursement and it's not taxable. Right?
Yep.
Okay, I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 3930, and we got all of our 32 offices open tonight, not
Till
7. And then starting next week on Monday, 9 to 9, and it'll be probably through next Saturday, 9 to 9 as
Right.
well.
Yep.
And the only office that we have that's open on Sunday is our McKinley Mall office.
Correct.
Right?
Right out in Blaisdell. And you can give them a call and make an appointment there if you want to get your taxes done on Sunday.
Okay, so we're going to take a short break. I'm Esther Gilius, the tax lady. I'll talk to you on the other side. Hey, we're family. That's how we think of you at EG Tax. I'm Esther Gilius, the tax lady with Chris Fabian from EG Tax. If you have any tax questions, give us a jingle, 8030930, star 930 on a cell phone or 3930, and we have a text. And so you read the text.
We must have hit somebody's button. It said, I got a 1099-C for a loan of almost $10,000 on 12/31/18 in the mail today. Does that mean the debt was paid off or discharged?
Okay, well, if it was 18, it should have gone on the 18 return. So if the 1099-C is for 2019, it means that was the amount that should have been discharged and paid off. But the IRS will be looking for the taxes on the $10,000. So the question is going to be whether or not you were insolvent, like Chris was saying, and then you can do a form which will make the $10,000 not taxable.
Right. So what they did was say, for an example, you might have owed $15,000 to this credit card, and they said, give us $5,000 and we'll call it good. So that's why the other $10,000 is on the 1099-C, which would count as income.
Right.
Because
maybe. So it all depends, Mr. Texter. It all depends on whether or not you had more liabilities than you had assets at the time of the discharge. So if you want to give us a call at the office, 632-7886, or email us through the website at egtax.com, we can go into this further, okay? All right. And the other thing is, before we get to your calls, 8030930, 8030930, star 930 on your cell phone, want to talk about gambling. And I think this is a great big misnomer that people don't understand. When you gamble and you get winnings, and then you lose the winnings. The income is a miscellaneous income, and the expense is an itemized deduction only if you can itemize. So if you're a married couple, your standard deduction is $24,400. If you gambled and won $5,000 at the casino and you lost that $5,000, the $5,000 would be an itemized deduction, provided your total itemized deductions come over that $24,400. If they don't, then you're stuck with that income on the front of the 1040.
Right. And then I know we have a lot of Canadian listeners too. If you come over here, it's an automatic 30% withholding at the time of winnings. That doesn't mean you're going to get that 30% when you file the tax return. You have to have the losses to back that up. So if you won $10,000, they withheld $3,000 for taxes, and you only lost $4,000 at the casino, you're not going to get all of that $3,000 back.
Right.
You're going to get $1,200 of that.
And so that's why it's really important to use your
card.
Your card.
Yep.
Right. So, but that's a real misnomer. People think that they can just net the two. It doesn't net. First there's income, then there's an expense.
Yep, because if you get that little yellow slip, the government's going to look for that on your tax return.
Because they get a copy of the little yellow slip too.
Yep.
All right, we're going to go to the phones. We're going to talk to Kevin. Hey, Kev, how can we help you, sir?
Hi, Esther. How you doing?
I'm great. What's happening?
Well, I'm at the park throwing a ball for my dog, but I got a little problem here. I had to take out $2,500 out of an insurance policy. I didn't pay the tax yet. Should I just send them like $500 or wait and see what happens when
Kevin, let me ask you a question. What kind of insurance policy did you take $2,500 from?
A Prudential.
But not from the company. What type of policy? Was it a whole life policy? Was it was it a death benefit policy? Was it a life insurance? What type of policy was it?
Life insurance, Esther.
All right. So you had a paid up policy and you were able to take some money out of it?
Yeah, I have a policy. I took $2,500 out, and they said I just have to pay the interest every year. So I figured that's taxable, right?
Okay, not necessarily. Most life insurance policies, even the ones that are paid up, don't have any appreciation when you consider the amount of the insurance. What I'd suggest you do, and this is going to make you feel very good, Kevin, call Prudential. You said it was Prudential, right?
Yeah.
Call Prudential on Monday and say, hey, I took $2,500 out of my life insurance policy. Is any of it taxable? They will tell you.
It was Prudential and John Hancock. Well, I can't.
All right, whatever. You call them and say, is any of this taxable? They will tell you.
Okay.
Okay?
Okay. And I'll be in to do my thing. Thank you.
All right. Thanks, Kevin. Bye-bye. He's going to be in to do his thing. I'm Esther Gulius, the tax lady from EG Tax. Give us a jingle here, 8030930, 8030930, star 930 on a cell phone. Text us at 3930, and we got Patty. Hey, Patty, how can we help you?
Yes, I wanted to know about the standard deductions for married filing jointly. I heard you say $2,400.
Mm-hmm.
All right, and we're 65. We're both 65.
All right, then you get a little larger standard deduction for being
$1,300 apiece.
Each one. So another $2,600 gets on to the $24,400.
You're going to be at $27,000.
So that would be your standard deduction, $27,000.
Oh, so it's $27,000.
If you're both over the age of 65, yes.
Yeah. Okay, and then I just deduct that from our total.
That's right. So if you're now, do you have a pension?
Yes.
All right, and Social Security, right?
Yes.
So how much is your pension?
The state we can't take nothing off of because they didn't take anything.
No, honey. How much is your pension? How much does your 1099-R say? How much is your pension?
Okay, just a minute.
Uh-oh.
My glasses.
Okay.
Is it like roughly $20,000, $30,000?
Yeah, I added up all the income.
I know, but you see, your Social Security may not be taxable at all, and that's what the problem is. When you're doing your own return, you don't know what's taxable. So some of your Social Security you might be counting as income, and it isn't taxable. So that's why I'm asking you, how much is your pension?
All right. I have two of them.
Okay, how much is it, Patty?
4,898
All right. And the other one?
is 4,600.
And do you have any other income besides those two pensions?
We have a 403.
Did you take money out of the 403?
Oh yes, because
How much, Patty?
we are
How much?
9,680.
Okay. And any other source of income? Interest from savings accounts, dividends from stock, rental property, small business?
Just $73.
Okay. And then your Social Security, right?
Yes,
How much is your Social Security?
mine is 6,576.
And how much is his?
17,206.80.
Okay, so when you take half of your Social Security and you add it towards your pensions, that total comes to $31,000. That's under $32,000. So none of your Social Security's taxable. That leaves you with total income of about $19,000. So you don't pay any taxes, Patty.
Oh, okay. Oh, thank you.
So if you would have put it on the tax return wrong, you would have paid taxes and you shouldn't have.
Okay.
Okay, hon?
All right. Thank you.
You're welcome. Bye-bye. That happens all the time. People tax themselves on Social Security, and it's
But
not
the
taxable.
computer took it. Or I
Right.
put it,
You
you
mean-
put,
you- well,
do
yeah,
it the
because the IRS is
old-fashioned way,
gonna
and you put it. And the
process it.
sad part is the IRS isn't going to send them a letter saying, you did it wrong, we owe you money.
Right. Well, sometimes they do. Not often, though. Okay, let's go back to the phones. 8030930, 8030930, star 930 on a cell phone. And our buddy here that wrote us a text said he was insolvent.
So, yep.
So what form does he have to do,
He has
Chris?
to do a 982.
So, Mr. Insolvent, you do a Form 982. You tell them, well, it says you're going to come see us, but you do a 982, and then you show that money that you received was due to an insolvency, and it won't be taxable. All right, we'll go back to the phones, and we're going to talk to Mike. Hi, Mike.
Hi. How much for a couple for itemized deductions do you need in medical bills before it be an advantage?
Well, that's one of the things that changed at Christmas time. It was 10% of your adjusted gross income. Now it's 7.5%. So that means it's easier to come up with deductible medical because of this change.
7% of what now?
Your adjusted gross income. So if you look at the bottom of page 1 of the 1040, not the very bottom because there's your standard deduction in there. It's like almost there. I don't know the exact line number, sorry, but it will say adjusted gross income, and that's what you take 7.5%.
Right. So
of.
if your adjusted gross income was 20, you'd have to reduce your medical by $1,500.
Oh, okay then. Okay, thank you.
All right. You're welcome, sir. Thanks for waiting. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Wanted to go down my list. I know we have callers coming in. So we talked about gambling, gifts, and inheritances. If I give you $1 million, Chris,
Woohoo!
how much of it's taxable?
None.
Right. So you can now do you as the person giving the gift would have the obligation, if it's more than $15,000, to file a gift tax return to adjust your unified exclusion. So when you die, they make sure that they get your inheritance money if it's taxable. But the recipient, Chris, who's very happy here that I just gave him $1 million.
When we have
not
all
really.
these listeners.
Right. It's tax-free to him. It's not deductible to me, but it's not taxable to him. When you get a gift for performing no services, no strings attached, it's tax-free. However, if it's an inheritance, then it may be taxable, right?
Depending on the
On
source.
the situation,
Yep.
right. So some of the income can be taxable, some of it might not, and we're going to talk about that in a sec, but I'm going to go back to the phones. 8030930, 8030930, star 930 on a cell phone, and we'll sneak Dave in. Hey, Dave.
Hi, Esther.
Hi.
my wife inherited her parents' house, sold it last fall, and we just got a 1099-S for the
Right,
house.
for the sale, right.
Right now, is that added on our taxes, or do we have to do one for the parents, a separate tax? Because they haven't been paying tax for years.
What was your whose
Wasn't
name
it
is
the
on-
parents that passed?
The parents, yes.
Okay, so the parents didn't sell the house. Your wife and you did, right?
Well, our attorney said to keep the house in my in-laws' house.
Well, okay. Was on the 1099? Is
Yes.
it in the estate of the parents, or is it in your wife's name?
No, just the estate of the father.
Okay, so it wasn't the estate did it then. Okay, you know what? This is kind of complicated. We got a break for news. Will you hang on?
Sure.
All right, thanks a lot. I'm Esther Gulius, the tax lady. We'll talk to you on the other side. We're going to break for news. I don't know if you can tell, but we care about your taxes. We're going to go back to Dave, who's waited. Hey, Dave.
Yes.
Okay, so when you started off, you said my wife inherited the house. But the truth was the house was in the estate of your parents, correct?
Right.
Okay,
And-
which is a completely different horse of a different color, it's possible that it could cost you some substantial taxes because you have to report that in the fiduciary return, and the taxes on a fiduciary return are much higher than if they would have gone through you in an inheritance.
Okay. Well, it sounds like we weren't planning. After 2 years ago when we passed, I was thinking, we'll probably be talking to one of you guys pretty soon. So we plan on bringing all the paperwork in.
Sure. Well, the thing is, so you're going to have to do a fiduciary return for mom and dad, and then your personal return.
Right. But you're going to need to know what the house was when the last parent passed. How
Right.
much the house was worth when
Were
the last
both mom
parent-
and dad? When did mom and dad pass?
She passed like 5 or 6 years before he did.
Okay, so you're going to need to know the fair market value of the house when she passed because he gets a 50% stepped up basis at the fair market value of her death, which will really help the estate when.
Okay.
Okay?
And then like I say that the house was still in his name when it was sold. So and the form, the federal form was in the estate of. Now he got an insurance policy about a year and a half ago, $7,000, $6,000, like that.
For what?
And we got a tax. It was in the state of that.
Probably for interest.
And so we got a tax form from the attorney. So that would all be wrapped.
Well, anyway, okay. But the whole thing is you got a fiduciary return for the estate of, and then your personal return. And so it's really not going to be reported on yours. It's going to be on the fiduciary return. That's what it sounds like.
Definitely, I don't want to do this.
All right. All right, Dave. Hey, thanks for holding on.
Welcome.
All right.
Okay.
All right. Thank you.
You know, the key thing is people have to look at the recipient's ID number. And I know a lot of them are truncated out except for the last four digits now. But see if it's yours or your wife's, or because if it's something different, that means there's going to be a different return.
And that's a really great point, Chris, because a lot of times people come in with 1099s that it's been sent to their house or W-2s sent to their house, and it's not for them. It's for maybe their kids, and they bring it in, and they think it all goes on their return. It doesn't. If it's payable to another payee, they're going to be looking, or taxpayer, they're going to be looking for that income on another return. So if you put it on yours, it's just going to generate an audit.
Right.
Okay. All right. Let's go back to. Oh, by the way, we have a text right here. By the way, that gentleman with the insolvency, yes, it's a 982. And do I have to claim my New York State property relief check as income on my state return? If so, what line? No. only if you are itemizing on your on your New York return, federal return on your Schedule A, and you're claiming property taxes and you got a property tax relief check, you would reduce the amount of property taxes you're taking as a Schedule A by that property relief check. That's where it goes. If you're not itemizing, just be glad that you don't have to claim it. Okay, let's go back to Dan. Hey, Dan, how can we help you?
Hi, Esther.
Hi.
Last year's refund, is that taxable?
No. Okay. On the federal or the state? Which one are you state refund or federal refund?
Wouldn't it be both?
Oh, no. The refund on the federal is never taxable. Okay? The refund on the state could be taxable if you had a benefit for New York State withholding on the Schedule A. But since the standard deduction was so high and they capped it at $10,000, there was, in most situations, there was no benefit. So in most situations, I'm saying most, have you seen one yet, Chris?
No.
It's not going to be taxable at all.
Thank you.
You're welcome. Bye-bye.
And
I'm
then-
Esther Gullius, the tax lady, 8030930, 8030930, star 930 on your cell phone. Text us at 3930. Yes, sir.
I'm going to throw more mud at the windshield on
Okay.
this state refund, because then if you were lucky enough to itemize on the federal and had a state refund, don't forget to back off your refundable credits on New York that you
That's
got on
exactly
New York State
true.
from that refund.
Which is really true. So, like, let's say you got a $2,000 New York State credit, and of the $2,000, $1,800 of it is an earned income credit from New York State. Well, you not only have to think about, did I get a credit of a benefit on my Schedule A for New York State withholding, but how much of it is in the refund? If the refund was $2,000 and $1,800 of it was an earned income credit, then you're only talking about potentially $200. And did you get that big of a benefit at all? And so you got to be able to do the math.
Yep.
Right? Okay, we're going to go to Jerry in Alden. Hi, Jerry.
Hi, Esther. I have a question on beneficiaries of IRAs. I think I've heard you talk about it before. Is a spouse beneficiary on an IRA, is the amount taxable?
Okay, so if your spouse dies, you get to roll over the IRA right into your IRA.
Okay,
So then, yes, it would be taxable.
say that again.
So, so because it's a spouse to spouse, you can roll it over based upon death. Okay.
Into your IRA.
Your IRA,
Right.
At
And-
some later point.
Yep. And then just like your IRA becomes taxable, so will her IRA become taxable to you too at the time of a distribution from it. Not the rollover, but just the distribution.
Okay, that's one. Now, if you have children as beneficiaries on an IRA, how long do they have any tax right away, or?
Well, they just
Oh, that's the horse of a different color.
When did your wife pass away? If this is your wife that we're talking about.
It isn't.
Oh, okay. So
It's planning.
okay. So since it's a new death from starting January 1st of 2020,
Okay.
your children would have to take the money out over 10 years.
Oh, okay.
They used to be able to do it over their life, but they just changed that on December 20th. So now you have to take it out over 10 years.
Okay. And is it the same? Well, I was going to ask if it's the same on a Roth, but I think.
Well, a Roth would be, you don't have to take the distribution on a Roth.
So if your spouse leaves you or your children a Roth, you don't have to take a tax on it.
Because it's not going to be taxable. There is no taxable basis on a Roth.
Even though it's taken out of the IRA after death of the.
Right, because it's coming out of the Roth IRA.
Right.
So it's never taxable. So whether you take it when you're alive or when you're dead, it's
tax-free.
Right, because there is no basis. It's all been taxed, or it isn't taxable at all.
Okay, that answers that. One last question. Is there a big difference? We have one annuity.
You mean how does an annuity work upon death?
Beneficiary.
The same rule, 10 years.
Okay.
Okay?
Okay, but the spouse, nothing on a
A spousal to spousal transfer because of death is completely allowed. It just goes from the one spouse to the other spouse, and it's not going to be taxable. It's a beneficiary, an adult beneficiary of an IRA or an annuity has to take it out over a 10-year period. So this is one of those changes that just took place at Christmas time.
Okay. Thank you very much.
You're very welcome.
Bye-bye.
Bye-bye. The important thing is to make sure that you put beneficiaries on your accounts, because if there's no beneficiary, then it becomes a real problem, because the only option the heir would have when it goes through probate and they decide who's going to get it is for them to take the whole thing all at once. So it's so simple. Just add a beneficiary.
Right. Because, again, the estate tax rate is 37%. After $12,500. So if you have $100,000 out there and no beneficiaries, $37,000 of it's going to the federal government.
Which is another change that just took place, thinking about the tax on an inheritance. The kiddie tax was altered, so now you don't have to worry about the kiddies paying taxes at the fiduciary rate. The kids will pay tax at the parents' highest rate. So that's another change that just happened at Christmas time. So you want to make sure what planning you might have done, you have to kind of think about, oh, well, that's not going that's now changed. So you got to make sure that you change your beneficiaries and your thinking, because all of that will maybe affect your estate.
Right.
All right, let's go back to the phones, and we'll go to Mike in Lackawanna. Hi, Mike. Hello. Oh, it's not Mike, it's Al. Al in Lackawanna.
Yes, hi, Esther.
Hi, how are you?
Okay, I have an annuity, and on December 30th, I took out $10,000 minus 25% federal tax.
Okay.
And I haven't received a tax statement in from them yet.
You will.
I will.
When did you get the check?
I got it January 4th.
You're not going to get the
You're not supposed to get it, yeah.
Yeah, you're going to get that 1099 next year.
Next year, because I got paid this year.
You got the income in 2020. It's not going to be taxable until you got the income, which would be 2020. And so next year they'll be sending you the 1099-R.
Even though I took it out on the December.
You didn't get, it's when you receive the cash, when it's constructively received, and you didn't receive it till 2020.
Okay, thank you, Esther.
You're welcome, sir. Bye-bye. I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930, and you can text us at 3930. Another thing we want to talk about is insurance claims and lawsuits. If you are the victim of a personal injury, is that taxable, Chris?
No.
Because
it's pain and suffering.
Right.
It's tax-free.
But most other lawsuits are taxable.
Right. If you're suing someone for age discrimination, taxable. If lost wages in an accident, the lost wages part of it would be taxable.
Right. How about public assistance?
Public assistance is tax-free.
Tax-free. Fiduciary and director fees?
Taxable.
Right. Recoveries. So let's say that you had in the past had a casualty loss. You thought that your house burned down and you took a casualty loss on your Schedule A. It was federally declared disaster area, and your casualty loss was $30,000. Then the next year, you got a check from the insurance company that you didn't know you had coming of $30,000.
Right. Then it would be taxable.
Because you had a benefit for it, now you got reimbursed.
Right. Almost like the Lake Ontario flooding of 2017.
Right.
New York was delaying, giving their money. People wrote it off, and then they eventually got their money. So it's
would
taxable.
be a taxable event.
Yep.
Scholarships, this is another interesting one. Last couple of days when I was doing tax returns, that I had students who had gotten excess scholarships. So a scholarship is not taxable.
Right.
Basically, if you're enrolled in a program of higher education for a degree program, and it's for tuition and fees, it's tax-free. However, if the tuition was $10,000 and you got a scholarship of $16,000, then what happens to that difference between the $10,000 for the tuition and fees and the $16,000 they gave you?
Well, it would be taxable.
Right. To whom?
To the child.
To the kid. Right.
And that's unearned income.
Right. And so that's another thing. So when you're getting these 1098Ts and you see that the amount that the kid got in scholarship was more than the tuition, that has to go on Junior's tax
right.
return.
So if you're looking at box 5 and it does say $16,000, box 1 says $10,000, and you're like, but my kid didn't get that $6,000. What the heck? Call the school. Get that itemized billing statement. See where that money went to.
Yeah, and and I have to tell you, just because you get a form and it doesn't make any sense, don't just pay the taxes and put it on your tax return. Go back to the person who did the typing of that 1099. They may not know taxes, and they would put it on the wrong line. I had a conversation yesterday because a lady had sold, one of my clients had sold a lot of acreage in Wheatfield. And she got a 1099 non-employee compensation for the sale. So what that means to me in tax lingo was that she performed a service and she's got to pay self-employment taxes on it. So we called the typer of the 1099 and he said, well, I didn't know what to do with it. So, you want to do your part to make sure that what they gave you was correct.
So what that means is he was going to tax her income tax and self-employment tax on it.
And really, it's neither because it's a capital asset.
Gains.
Right.
So she would have got a reduced
It should have been a 1099-S.
Right.
Right? Okay, let's go back to the phones, and we're going to talk to Mike in West Seneca. Hi, Mike.
Hi. I have a pension that was, I worked for Ingersoll Rand for 17 years, and left the company about 10 years ago. The pension was still in there, but now they're asking me to, just this year, to roll it over into either my 401k or something else. And I was wondering, there's about $403,000 into that.
Wow, good for you.
Yeah, would it be beneficial for me to do that in a current IRA or current 401k that I'm doing, or is this something that I should?
Well, I'll tell you what it'll do. If you put it into an IRA, it'll give you a lot of flexibility because you then don't, you can control it yourself. You can as opposed to the 401k plan where it's the company directing where the funds go. So if you're kind of somebody that's good at numbers and you want to do it yourself, if you roll it over into an IRA, you can control it yourself. If you put it into the 401k plan, then that's
you got to check with your employer to make
right.
sure they would take it first.
Right.
Okay.
Okay.
So would I have to pay tax on that then?
No. It's a direct rollover, trustee to trustee, and so it'll be completely a tax-free event until you start to take it out.
What would you suggest if you were doing that?
I would do it. I'd put it into an IRA.
Okay.
Because I'm kind of a control freak. So I wouldn't. Because I would think if I roll it over to the company and they mess it up and I lose everything, in the company, that's at least it's some kind of diversification. And if I had control of the $403,000 myself, then I can be responsible for it. Maybe I want to make it more conservative. So it's that's what I would do.
Okay.
Okay.
Well, thank you very much.
All right. Thanks a whole lot. Bye-bye. Because I am a control freak. Okay, we're going to go back to Dave in Buffalo. Hi, Dave. How can we help you, sir?
Interested in knowing if there was a federal tax credit for a new heating system that was put in.
Only if it's solar.
Oh, solar only.
Yeah,
Right.
you just did a new furnace?
I did a furnace in December. Yep. I'm aware of the credit I'll get from National Fuel. But I wondered if there was anything.
Not anymore. They got rid of that stuff a couple of years ago. It died a death, then they let it go. Now at Christmas time, when they did all this change, the Secure Act, they revamped the tuition and fees and things of that nature. Who knows? Next year they could put it back, but right now it's not in the law.
But would that help me next year?
No, it won't.
In things.
No. Never fails, does it, Dave?
No, it doesn't. I miss.
It's always when you do it. They change the law.
You know, you guys do a great job. I listen every week. Thanks for your help.
Okay, Dave. Thanks for calling.
Bye-bye.
Bye-bye. Okay, we're going to go to Fred. Hey, Fred.
Hello.
How you doing? What can we do for you?
I received a 1099 for interest that I never received last year. It's owed to me, but I haven't received it yet.
Okay, so the whole thing is, just because you didn't receive it doesn't mean it's not in your account. So if you could have gotten it out of your account, you received it.
It's due to some arbitration. So it's not in my account.
No.
It's not in my control.
Okay, so you did not constructively receive that? In other words, when somebody's doing the accounting, nobody said, this money goes to Fred, this money goes to Fred, this money goes to Fred. Even though you didn't get it, it is in your account.
No, it isn't.
Then you need to talk to the person that issued the 1099 and ask why they did that.
All right.
Okay?
All right, thank you.
All right, thanks. Bye-bye. We're going to go to Tom. Hi, Tom. How can we help you, sir?
I got a 1099 for $400 interest from a CD. I don't file taxes because I'm Social Security disability, $13.50 a month. Does the IRS still want their money?
No. You see, there's a minimum. There's a minimum standard deduction. You're a single guy or married guy?
Single.
All right. So 12.2 is your. You're not 65, are you?
No, I'm 62.
Okay, so 12.2 before you have to have taxable income that exceeds 12.2 before you're going to pay any taxes, okay? So if your only source of income is that Social Security and disability and this little bit of interest, it's not going to be taxable. If, however, though, you had a bunch of other income, then and it exceeded the 12.2, then you would have to file, and they would want their money.
Now I'm going to make my wife proud. Do you rent or own a home?
I own.
Okay, is it worth more than $85,000 or less than $85,000?
Less.
Do you file the New York 214 and get like a couple $100 or 50? You know, how old are you?
62.
62. Okay, you could be getting $50 to $60 back from New York State
on an IT 214.
IT 214. Oh boy. I haven't.
Well, you know,
$60
Chris is just trying to help you.
Okay.
Okay, Tom.
I'll have to get a hold of you guys. Okay.
All right. Talk to you later. Bye-bye. What do we charge? $5 to do that or some ridiculous thing. Anyway, I'm Esther Golias, the tax lady. What we're doing is we didn't take a break at 45. So what we do is we're going to, all during tax season, because we have clients back at the office, so we're going to leave at 5 minutes to 4. So we aren't taking any more phone calls. But I will tell you, during the week, if you need any help, you can go to our website at egtax.com, ask the tax lady. You can call our offices if they're able to help you. Don't think it's rude if they are with a client and would have to call you back. The best way to get your tax questions answered, though, is to go to our website, wouldn't you think?
Yep. Definitely.
Not that we don't talk to people, because we certainly do. We answer all kinds of tax questions. You can always call our corporate office at 632-7886 if somebody's
Stop
free.
in one of our offices
right, and
ask
they
too.
certainly will help you if you have a tax question. But until next week, I'm Esther Golias, the tax lady from EG Tax with Chris Fabian. Thank you, Mr. Chris.
Thanks for letting me out.
All right, thanks a lot for listening.
I'm looking for that $1 million.
Bye-bye.